A lot of traders do want to take into consideration the slope of one of the moving averages. Now, in this case, it is the 13 EMA. Now, a standard moving average with the slope would be something like a 20. Now, if the slope is in one direction, you'd be looking at momentum in that direction, and that would be the direction you'd want to trade. So let's back this up a little bit. We'll take a look at this with a clean chart. And you know what I'm going to do is I'll put on a two-colored moving average here. So I've got a two-colored version of this. So let's put on a two-color moving average. Now it'll color green when the slope is up and it'll color red when the slope is down. Now this is just purely for video purposes so that you can see this, demonstration purposes. Now there are traders that do want to trade with the direction of the slope of the moving average. Now, when it comes to the slope of a moving average, generally that is going to be a simple moving average or an SMA. Now, you can do it with an EMA. The EMA tends to get a little bit choppy and the slope doesn't flow quite the same way. With an SMA, we get a better idea of the slope direction just because it's a little more smoothed out. So if we're taking a look at this, we'd be looking at a trend and how this indicator or how the 13 EMA will slope in the direction of the trend, and we'd be looking for those trading opportunities in the direction of the slope. So when we go back, what we're taking a look at is the overall trend is these three different moving averages. Now we can even get rid of one of these. We can simplify that a bit. Let's take a look at two moving averages and how this one moving average slopes in a certain direction. And that would be the trend that you'd want to take, or the direction of the trade that you'd want to take. You have this slope, you have a sloping moving average with a longer term moving average. And in this case, we've got a 13 and we've got a 50. When we've got a downtrend and the 13 is underneath the 50, we've got sections where the moving average is sloping down and sections where the moving average is sloping up. Now, when the averages are sloping up, generally in a downtrend, what we're going to see is convergence. We'll see that these moving averages are coming together. Now, that suggests to us that for a short time, we're seeing more upward momentum than downward momentum. Now, that's just going to be a short-lived thing most of the time. We've got an overall direction in one direction, but a short-lived change in direction for a small period of time. What we've got is the downtrend. The price pulls back and it changes the slope. So when it changes the slope to green, we'd be looking for buys, but because it's in a downtrend, we wouldn't be looking for anything. So what we're looking at here is the change in the sloping direction, and we want to take a trade in that sloping direction. So the next thing that happens is we get this market pulling into that 13 EMA, and that gives us an idea or an area at least where we could be looking for a trend following trade with that slope. So we get that market pulling back into that 13 EMA. The slope is down, so we're looking for an opportunity to take a short trade in here. Market pulls back into that 13 EMA. The slope is still down, so we would be looking for an opportunity to sell. But the thing here is we've got some separation. We've got these two moving averages quite separated. So the market is going to be considered overextended, which would mean that this is not going to be valid. We're going to have an overextended market and we aren't going to be looking for any kind of opportunities at that point, simply because we've got an overextended down market. Now what happens is a following move up, turning that moving average green. It slopes up. Then that is followed by, again, some convergence. We see these moving averages coming together, and as they turn red, we are looking for an opportunity to take that short trade. And that short trade is right under here. And we get that nice follow through. And again, we see that over and over as this continues to move. Let's just delete some of this. We see that right in here as well. So we have this downtrend because we've got the 13 below the 50, and we have a type of sensitivity measure. This 13 EMA and its slope is going to tell us if the market's momentum is moving in the right direction. So we get that slope turns around in here. We get that short opportunity in here. Now, as these moving averages do change directions, we'll be looking at a potential for the upside. Now, this one takes a nice move to the upside. We have the moving averages turning long, and then they cross over. They stay green as the price moves up, but we don't really get a nice opportunity in this. What we're looking at is a huge gap right in this area here. We get this big gap between the two different moving averages. So going for any kind of trade up in here is just a bad idea. We're looking at an overextended market, and from that overextended market, we're not going to be entertaining any trades. The price pulls back. The slope of that moving average turns red. So there is a nice section in here where we do get an uptrend, but no triggers. We get a section in here that's overextended. We get a section in here that is less extended, but no trade gets triggered. The market continues to pull back and go the opposite way. And then we get the opportunities to go short in here and in here. So having the slope on a moving average can be helpful. And having that moving average change colors is also very helpful if this is something that you want to pay attention to. If you're looking at the slope of the different moving averages, again, you still want to pay attention to the trend. You want to pay attention to the direction of the markets. You want to pay attention to where the candles are in relationship to those moving averages. You want to pay attention to how far apart these moving averages are separated. Just because we have a slope, it shows us market momentum, but it does not give us overextended markets until we get that separation. Now this moving average, because it is red and green, it's just a really nice visual. You can see the difference between the slopes. You can see what is sloping up and what is sloping down. But you want to always remember the trend is your friend. Whether you're trading with the trend or against the trend, having some way to identify the trend is going to be helpful in your trading. And if you can identify the trend direction, you can identify where the trend is strong, and you can identify where the trend is weak, and you can identify where the trend is likely to continue to move, and identify where the trend is likely to stop and make a reversal as it becomes overextended. So we were talking about the slope of these moving averages, and this is essentially how you would use or take advantage of the slope. It just gives you a better idea of market momentum. And you want to make sure that that momentum is in the same direction as the trend and not overextended. If you're interested in these topics and you find these helpful, please let me know. I need your feedback in order to know what kind of videos you want me to continue making. Please like and subscribe, and I will see you in the next video.